Hey guys, this is Nick Brown. First things first, check this shirt out. This was $12 at Target. Always a great find at Target. Can't ever pass up a Star Wars shirt. Everyone knows that, especially for 12 bucks. All right, so today we're going to talk about escrows. What are escrows, and should you waive escrows or have the mortgage company pay them for you? So first, let's talk about what an escrow is. In your monthly payment, your payment is broken down into 4 parts and sometimes 5 with mortgage insurance, but really the 4 parts are taxes. The 4 parts are principal, interest, taxes, and insurance. The lender wants to pay your taxes and insurance for you every month because they're big bills and they don't want those bills to come due and you not have the money to pay them. Taxes, that makes sense if you've ever seen Happy Gilmore. I always give this example. Happy at the beginning goes over to his grandma's house and he says, hey, they're literally evicting his grandma, and he goes, what are you guys doing? And his grandma, or the guy's like, oh, your grandma didn't pay any taxes, Happy. And he's like, what are you talking about, grandma? What's going on? And she goes, I don't know. And so he goes, well, no problem, I'll write you a check. How much does she owe? And the guy's like, $250,000, Happy. And he looks at grandma and he's like, what? Well, taxes are one of the only things that can jump in front of the lender and seize the property and recoup their money. So lenders don't want that to happen. So they want to pay the taxes for you every month. They're going to collect a little bit, and when those are due, pay them. Same with homeowners insurance. They don't want you to go on a 3-month vacation and then come back and your house burned down, and you call up your insurance company and say, hey, insurance guy, my house burned down, but good thing I have insurance. And he says to you, actually, you forgot to pay it a month ago and we canceled your insurance, and now you just have a pile of dirt. That's not good either. So the lender really wants to protect themselves by getting the homeowners insurance and taxes collected for you and pay those out. And so those are called escrows. Why do we call them escrows? Well, escrow is just a fancy way of saying holding account. And so the bank collects them, puts them in the holding account or escrow account for you and pays them as they come due. And that's why we call it an escrow account, or escrows for short. So there is an option for you to pay escrows instead of having the lender collect them. Now, would this ever be a good idea? And what are the pros and cons of this? Now, the reason people always give as to why they want to collect or not collect the escrows and why they want to pay them out on their own is because they say, oh, the lender is taking all that money and they're holding that money from me and investing it and making money on my escrow account. And whether or not that's true or not, it is a valid point, but it's not really as valid as they think. See, because at any given time, the average in the account is always somewhere between 0 and complete amount you would need to be funded to pay everything. So you take the 2 and you add them up and divide by 2, and the average in the account is never going to really ever be more than 50% of the total payment. So that's never really going to be more than maybe $1,000 on average in the account. And so really, let's say you make 10% in the marketplace on $1,000, you might save, like, I don't know, maybe tops like $100 a year. Not a big number. Usually though, there's not that much money in the account. It's going up and down as the bills are coming due. It's paying it to 0, and then for the next 3 months it has like nothing in there until it builds back up and it's due. And the only time the account really has a lot of money in there is right before they're going to make the payments for you. So you're really not making that much money. And also, it costs you upfront to waive escrows. It will cost you typically about a quarter of the loan size. So let's say your loan here in Denver, an average loan size might be $400,000. So you would have to pay $1,000 up front to waive escrows. So that means over the life of that loan, however long you're going to have it, you better make that $1,000 back. Otherwise, it wasn't worth it, because it's probably going to take you around 10 years with 10% interest return to get that money back. Most people refi or move every 4 to 7 years. So in that sense, it really doesn't make a lot of sense. The second thing is, it's a big bill, these taxes and insurance, when they come due. So if you can avoid paying big chunks of money every year, it's going to hurt. It's basically twice a year, you're going to have, a $2,000 payment for taxes and a $1,500 payment for home insurance. So it would just be a lot easier to let them collect 1/12 as they go and pay it when it comes due. So really, there's not a very good reason, unless you're an incredibly savvy investor. And even then, I've had incredibly savvy investors as clients, and they're not waiving escrows. That's just not that big of a deal to them to save, $10 a month, if that. So that is basically my take on if you should or shouldn't waive escrows or pay them on your own. My take is leave them in the mortgage, let the mortgage company collect them for you and pay it. You'll thank me. I had one guy who did it, and I saw him 5 years later, and he said he dreaded paying those 2 payments every year, and wishes he would have just escrowed. So that's all I got for you guys today. Have a great rest of your day, and thanks for watching.